Good morning. I can see we've got a few people dialing in. Can somebody give me a thumbs up if you can hear me okay? Thanks, Rich. So we've got quite a few people that we're waiting to still log in. I'll just give it a few more moments. If they're not in, we'll kick off regardless. It may be that quite a number of them are just waiting to access the recording too. So we'll jump in just another moment. Hey, Rich. Okay, well, look, we will kick off just so that we don't hold you up any longer than what's anticipated this morning. Welcome, everyone, and thanks for joining us. We'll just jump straight in. Nathan McGrath's my name, and I'm the Senior Business Advisor with Strategy360 by Collins Hume. For the benefit of those that aren't overly familiar with Collins Hume, just a little bit of background. We're an accounting and advisory firm. We've been operating continuously for approximately 45 years. Strategy360 by Collins Hume, that's our dedicated advisory businesses. So our advisory resources and capabilities, they purely focus on the needs of both Collins Hume's tax and compliance clients and servicing them with advisory services, but it also works with businesses that utilise outside accounting services to our firm. The work we do, it's driven around just improving the future position of the business. So specifically financial performance, owner earnings, increasing the value of the business, and importantly too, improving the lifestyle outcomes for the owner. Our approach and how we do it, so it's around adding material value to the business, being that we focus on providing tangible outcomes, so things that you can touch and feel and see within the business and the performance of the business. So that said, we regularly work with businesses on monitoring and tracking performance, ensuring that plans and actions that are being implemented are actually showing up in the performance of the business. So areas like business valuations, strategic and business planning, financial forecasting, testing scenarios, mentoring and coaching, they're all regular services that we provide to owners and their team. So that said, now we'll move on into the presentation. And the first thing I just want to mention is, before I jump too far ahead, is 29% of Australian SMEs said in the recent ABS Business and Conditions Sentiment Report that they would have difficulty in meeting their financial commitments over the coming 4 weeks. So that's 1 in 3 businesses that are expecting and concerned about difficulty in having the financial capacity to meet the outgoing needs of their business over that 4-week period. And that's the thing about cash flow is, the business, as we know, a business can be profitable, it can be growing, it can be busy, and it can still run out of cash. So the reason and the underlying, theme of what we're looking today is profit. It's relatively easy to see. It's right there on our profit and loss statement. Cash, however, it isn't quite so visible, and it's not really there staring us in the face. So today what we want to look at is where cash sits in the business, what we can do to improve the cash performance of the business that we generate from operations. The intention today, so It's not to get too technical. We're aware that you have a lot of experience in your own businesses and a lot of expertise with regards to the industries that you deal in. With that said, what we're really looking to do today is to get a look at the foundations of good cash performance and provoke deeper thought within yourselves around the opportunities that may exist within your own businesses. I think this is a great statement. You can't spend accounting profit, but you can spend the cash that's in your bank account. And generally, we understand this intuitively, but I think that's an important distinction to make at the outset. You can have a profitable business and still find yourself under pressure if that profit hasn't actually converted into cash that you're holding in your bank account. And that's really what we're looking at today. It's the ultimate outcome of what we want is having that cash available in the bank account and not necessarily sitting in other areas of the business. Today's session, we've got it booked for 45 minutes and we will have it well and truly wrapped up within those 45 minutes. I'll keep it moving as quick as I can. I'll keep an eye on the chat. If you have any questions, please just put them in the chat. And if I don't happen to capture it and I move past it, please just raise your hand or give a thumbs up or something to just draw my attention to that. Just to telegraph what we're going to look at today and just probably what I want to preempt in yourselves and to keep your thoughts and awareness of is that cash flow, it's about timing. It's about freeing up cash that moves through your business and getting visibility on where that cash sits. So, as we said a moment ago, is that, the profit and loss statement, it really does spell out and show us clearly how profitable the business is. But the cash, it's a little more ambiguous to see. So we'll look at the levers that you can pull that can improve cash. So we'll have a look at some really practical slides in a moment. So we'll jump straight in. And just to get a bit of a background on why cash matters, is I strongly believe I don't think cash has ever been more important in a business. The current environment that we see ourselves in, we've got rising material costs, wages, labour is increasing, insurances, utility, fuels. We have a higher interest rate environment at the moment, and all this creates ongoing pressure as the cost of business is increasing. The majority of businesses that certainly I speak with certainly agree that there is a level of comfort in knowing that the business is generating surplus cash and has cash available in the business so that it can meet its forward-looking expenses. So anyway, look, we'll just take a bit of a step through why cash matters. You can see it there on your screen. Some of the real basic needs of it, but I think it's good just to recapture that in our thoughts, is that it provides the basis of funding the business. So it allows us to pay staff. Having cash lets us pay suppliers. It allows us to pay rent and electricity, etc. It gives us a level of liquidity there so that the business has the capacity to withstand pressures if they arise, and also to not immediately force a business into difficult decisions. The capacity for investment and growth, whether that's hiring staff, developing new products or services, investing in systems, marketing expenditure, etc. It's an investment there and a capacity there what we can make in the business. Provides earnings for owners, so it provides the ability to take earnings out of the business for owners. Cash also improves credibility with lenders. Debt's not a bad thing in all cases. It can be the way that we fund growth, and it can have a very positive impact on business. So having good cash flow, it demonstrates to lenders and investors that there's financial discipline in the business, and there's a capacity there too to service debt and or a capacity to pay a return to investors. It provides resilience. Now, that's probably an interesting term. I think over the last 6 to 8 years, resilience is a term that, in my view, I think we've overused it, and at times it's lost its meaning. But, you know, as we look at it now, it's certainly become a real competitive advantage. You know, as you know, in these times where we see uncertainty probably as the new certainty, you know, resilience, whether that's through a downturn, whether it's a disruption that we see, whether it's things like losing a major customer contract, for example, you know, having cash reserves, you know, gives the business options, and it really does sort of underpin that ability for resilience. There's also a valuation consideration here too, you know, generating free cash flow, you know, being able to fund operations and have cash flow left after the fact. You know, it's an important value driver when valuing the business. So, you know, it demonstrates to buyers or investors that the business has the capacity to either A, service loan to pay back the debt to acquire your business, or it also demonstrates that there's capacity to pay a return back to the owner as well. So, and you know, we're seeing the CGT reforms, and it's putting probably more of a focus on the valuation of businesses as we look between now and coming into 1 July. So, you know, an important consideration to keep in our minds too when we're considering cash flow. And lastly, there, you know, can reduce stress, and you know, it's another whole workshop probably in itself. But you know, I think we all, you know, the shoulders relax and the load feels a little bit lighter when we know that there's enough cash there in the business to meet the forward outgoings that we're looking at. So when we're looking at cash flow, you know, it's not so much about an accounting measure. You know, it's very much about having operating capacity within the business. So this brings us to an important distinction. Profit does not equal cash. And for me, this is probably one of the more important slides of today. You've probably heard the expression, revenue is vanity, profit is sanity, cash is king or queen. And I think anyone that's experienced a near-death business experience with cash flow will understand that expression pretty well. You know, cash, it's the oxygen of business. When we consider us as humans, you know, we realise we can survive a period of time without food. You know, we can get by for a period of time without water. You know, but when the oxygen stops, it's over shortly thereafter. Apologies, you know, on one for an analogy, and it's the same with a business too. Is that, you know, we can survive for a period of time with revenues declining. We can get by for some time with margins contracting, but when the cash stops, you know, it literally is lights out. But while cash is king, you know, we'll also acknowledge the relationship between profit and cash, and we'll come to that in a minute. And it's an area that I think we can, as advisors, overlook sometimes. But the question for now is how effective is the business converting profit into cash? Now, this slide here, we will go through the numbers, but the numbers aren't specifically important. What's important here is getting a little more visibility on where cash sits in the business, as well as to trigger some thoughts relating to your own business just as we talk this. So, you know, I hope it might just flush out some things that you can just jot down, you know, as we go through and talk through some of these things. Just checking the chat there for a moment to see if there was any questions in there. Okay, so we'll look at this slide here. And again, you know, the numbers, whilst I'll talk to them, you know, it's not specifically them that I guess that we're looking at. When we look down the left-hand side there, we can see that the business has generated a profit of $498,000. And that's a pretty healthy profit on that $4.3 million. But on the operating cash flow, it's generated $126,000. So when we look between the operating profit and the cash flow that's been generated from that, there's a variance of $371,000. And that's the question, I guess, is where is the $371,000? And again, and I'll keep reiterating this, you know, in looking at this slide, it's not so much the numbers on it that is specifically important, but it's that realization that, okay, you know, we're generating profit, but are we actually generating strong and healthy cash flows out of that? So when we look at this, there's three movements that have impacted this client with regards to cash. So firstly, When we look at the revenue line, the business had revenues of $4.3 million and had cash from customers, excuse me, of $4.1 million, demonstrating that of that $4.3 million in sales over this 12-month period, the business collected only $4.1 million of that. So the business still has $198,000, I'll just click and catch up with myself, in debtors that are still outstanding. So simply, the sale was made, but the business has not yet collected all of the cash. Secondly, cost of goods. The business has purchased $3.1 million in materials or inventory to achieve the $4.3 million in sales, and it's carrying $3.2 million in inventory for that period. So specifically, this business still has $179,000 of inventory that has not been sold. So that's funds that the business has committed, but hasn't yet converted into cash. So it's the business's funds. It's still there in the business. It just hasn't been converted into cash over that 12-month period. So, and lastly, there's an increase in creditors of $7,500. So, and that's actually a positive thing. So, whilst it's only a seemingly small number, what it does demonstrate is that so this business has started to pay their creditors a little bit slower, still within terms, but they're actually making better use of supply credit. So their creditors have increased, but that's just demonstrating that they're holding on to their cash a little bit longer. So when we combine those three, we can explain the movements of the $371,000 in the cash variance. And again, the important point isn't necessarily the precise numbers. The important point is that the cash hasn't disappeared. So it's still there within the business, and you can probably see we're moving towards the timings of cash flow. But it's sitting there in working capital in particular. So that's primarily in receivables, so they're debtors, and inventory, or WIP if it's a service-related business. And for a service-related business, we're looking at work in progress. So that's the services that have been delivered, but have not yet been invoiced to clients. Is this useful information? Are there any questions at this point? Okay. So as I said, the timing factor starts to come in there as we can see that, that $198,000 variance between the revenue and the cash collected, it's outstanding debtors essentially. So now we'll just get back quickly to the relationship between profit and cash. And no doubt you've probably seen this already and recognised it here on the screen, or you're seeing it in your own numbers. But what we can see is that if we generate more profit, it gives the opportunity for the business to produce more cash. But again, the key item here is that that's only if the business is effective at converting cash into profit. So if your strategy to increase profit is through growing sales revenue, it's important to understand, how does that growth impact cash flow? Because the outcome around growing sales can sometimes be surprising, and we'll look at that in a moment. We'll look at that in a moment, and I'm trying not to jump to that too quickly because that will probably flush out a few other questions within your mind too. But just before we finish up on this slide, so when we look here, we can see that this business has a cash conversion rate of about 25%. So that is that the $126,000 that it's generated in cash flow is about 25% of the profit that the business has produced. Now, bring that up because we're currently working with a client that has a cash conversion rate of approximately 99%, which is an outstanding result. And why I raise that is because there's iterations to the improvements that the owner of that business has made. So there's your high level or your first stroke debtors, inventory, creditors, or WIP there as opposed to work in progress as opposed to your inventory. But it also look at gone to further deeper layers around improving cash flow, and that's by looking at areas around improving productivity and utilisation improvements. So they're actively looking at improving the profitability of the business to allow them to leverage that good management of working capital that they have. They're looking at the invoicing frequency. Now, this is a services business, so invoicing frequency is playing a part there for them too. Reducing the lag that occurs as the business hands work across different divisions within the organisation to service that client. Now, I've just had a Rich. So this is professional services. So this is around surveying and mapping is the type of business that this business relates to. So they don't carry inventory, but they do have a lot of work in progress. So when they start, they incur wages and haven't yet invoiced the client for work. So very much a services-driven business. And a good point that you brought that up, because it's worth acknowledging that 99% conversion rate may be completely out of reach for the profile of many industries, and that's at no floor of the individual businesses. It's just by nature of the structure of the industry. However, importantly, I guess why I mention that is that that business wasn't always operating at 99% or thereabouts of its of cash conversion rate, but it was able to improve its position there. So they're the things that I'd start to be flashing out and just formulating in your own minds is what opportunities might exist within your business. What cash value might those opportunities represent, and how could you use that cash in your business? So again, the intention of this slide, I know there was a lot of numbers in there, and it wasn't specifically about them, but it was to demonstrate that profit is not equal to cash, and the importance of not confusing profit for cash as well. So that said, being that profit is not equal to cash, and what cash flow relies on is how effective the business is at converting profit into cash. The next question is naturally that, well, what does impact cash and profit in the business? So, and there's 7 levers within the business that can impact the performance of cash flow, and that's price, it's volume, it's cost of goods sold, operating expenses, your debtor days, inventory days, or WIP days, and credit days. Now, the first 4 of those, price, volume, cost of goods, operating expenses, they influence profit. So they can influence the volume of profit that you're generating, from which you've got to convert into cash. And you'll find those on your profit and loss statement. The last 3, looking at their debtor days, inventory or WIP days, creditor days. So that looks at the direct impact of timing of cash that's moving through your business and where the opportunities sit to free up cash. So whether that's in your receivables, your inventory, your WIP, or your payables. And those items, they will sit on your balance sheet. Now, again, I just want to bring the practical sense to this, is that we're not looking at abstract accounting concepts here. Somebody or teams of people in the business are making decisions that affect each one of these 7 levers, and that might be the owners of the business, it might be the sales team, it might be finance and admin, could be operations, purchasing. If you're in manufacturing, could be a scheduling manager. There's any number of people that are involved in decisions in the business on a daily basis that can impact cash flow. The important thing is that the business understands, what those decisions have on cash. So because there's decisions being made throughout the business on a regular occurrence, it's important that if there's teams that have influence and individuals, that they understand what impact that they can have on the actual cash performance of the business. And we start to see there too is that it's an outcome of management, good cash flow, rather than simply an accounting issue. And I know at times, even ourselves in the industry, we can look at it more from an accounting lens issue, more so than being just practical management within the business. I'll just quickly stop, see if there's any chats, any questions in the chats. Again, is this helpful so far? Is there any questions so far? Great, thanks for the thumbs up. Okay, now I think you're going to really find these next two slides really thought-provoking to your own businesses, and this is really the meat and potatoes of today. Particularly from looking at it from a practical point of view. So we know where those 7 levers are that can impact the business. So what we're going to look at now is what that impact actually represents. And we regularly work with our clients looking at this exact profile. And you'll see why we do that, because the results and the value out of this is significant. So what we're looking at here is the actual impact of cash and profit on making small movements to each of those 7 levers within a business. And for context, what we're looking at here, so it's a business that turns over around $4 million. So it is a business that does carry inventory. But what I can tell you is that over recent times, having dealt with businesses with revenue of $500,000 to $15 odd million, there's significant benefits right across each size of those businesses. So yes, this business has turnover about $4 million. Whether yours has less or more, from what we see is that there are strong benefits to be had out of looking at this type of exercise. So what I'll do is I'm just going to run through this. So again, what we're looking at is in this business. So I'll start at the top with a price increase. Is if this business increased its prices by 1% over the 12-month period, it would have produced $28,000 more in cash over that period. In that same period, the price increase would have impacted profitability by $43,000. Interestingly, when we get to the next line, the volume increase, if this business increased its volume by 1%, it would have actually consumed $9,000 more of cash. So it would have had a negative effect of $9,000 on cash. However, it would have lifted profit by $12,000. And the reason for that, if we look at those top 2 lines, if we increase price, nothing's changing. All we're doing is increasing the margin, increasing the gross profit dollars. It'll flow through to the profit line of the business. When we increase volume, is that there's a cost to growth. So when we increase the volume, we might have more debtors. We might have more inventory, for example. We might have more WIP that's being consumed, that's being tied up in the business, or that's tying up cash in the business. So that's an important distinction to make there. This particular business, when we look at costs of goods, so relating around its gross profit, so if it reduced its cost of goods by 1%, $37,000 cash benefit or uplift, and a $31,000 improvement in profit over that 12-month period. Overheads, again, so we're now looking at the operating expenses of the business. A 1% reduction in operating expenses would have provided a $7,000 improvement to cash, and it would have provided an improvement of $7,000 in operating profit. Then we get to these working capital measures in the balance sheet items is so receivable days. So a 1-day reduction in how fast it collects its debtors, $11,000 cash improvement. A 1-day reduction in inventory that it's holding would have improved cash by $8,000. And if it paid its suppliers 1 day later, obviously still within terms, it would have increased cash by $8,000. Now, the reason I just wanted to go through these is that you can see across here that not all of those obviously have the same impact on cash, but it's a really good exercise too to see, well, what does provide the biggest impact on cash? So, and in this case, we can see that its cost of goods, a reduction there would have, by 1%, would have had the biggest impact. But when looking at that, the key aspect there is that each business will have a different profile, and each of you will have a different view around what's achievable within your business. So really what we've looked at here is to give you visibility of where those impacts are on improving cash that you generate over a 12-month period or any period, and profit. And for this business, as I said, it was lowering the cost of goods. So the concept from here with this slide is the impact isn't necessarily the same across each lever, but we can see that in the volume case, it can have a negative impact. And that's why getting visibility on the numbers is important. Getting an understanding of how it impacts your business, because growth in particular, when we're pursuing growth strategies, it can have a particularly telling impact on cash flow. Strategically, it might be the absolute right decision to make long term, but obviously having an awareness around this is critical to the decisions that you make ongoing. We work through this type of analysis, as I said, with many of our clients on either a quarterly or a 6-monthly basis. The reason that we do that is so that we can see the potential impact before a decision is made and anything is impacted. And equally as important, we can look back and see whether prior decisions that have been made are actually showing up in the financial performance of the business. And when you actually put the numbers in front of you, I hope that by yourselves looking at this is that, again, it's just flushing out some things in your own mind that you might just want to look at more closely in your business or just uncover a little further within your own business. And, when it's in front of you, we can start to ask questions, of ourselves in our businesses around, it might be the pricing increase. Is our pricing policy correct? Do we have the right mechanisms for price increases? Are we managing prices in a structural way, or is it more ad hoc that might be costing us opportunities? It may be looking at an investment that you're looking to make in productivity. Well, how does that show up in the overall result of the business? How does it affect cash? How does it affect profit? And what is the impact on strategy, on the overall cash position of the business? Okay, now let's just shift forward. Sorry, I'm just checking the chat again to see if there's any questions in there. Okay, was that helpful? It was looking at that. Was that beneficial? Did it raise some thoughts? Did it trigger some maybe actions that you might want to look at in your own businesses? Okay, this slide here, again, what we're looking at here is the same screen, but we're looking at the actual impact of making change on the business's performance around cash. So I'll just run through this. So after analysing this with the client and evaluating the position of the business, what the owner was able to determine was, okay, again, what's achievable within the business? And where did they want to implement change that they saw that they could action effectively? So I'll just work through these. Is price increase. This particular business actually manages its price increase as well. It does it on an annual basis. Volume, the nature of its industry, it feels as though with the competing pressures that are going on in the marketplace that achieving growth isn't really an option for this 12-month period. Cost of goods reduction. Again, they just want to maintain good relationships with their suppliers. They think they're being relatively productive, so it wasn't viewed as a big opportunity in their business. However, when they got to overheads, they did feel as though they maybe weren't managing them with as much discipline as they felt they could. So they thought conservatively, a 2% reduction in overheads is more than achievable. So that's going to have a $15,000 positive impact on cash flow over 12 months, and it will have the same figure impact on the profit. This particular business, by their own admission, wasn't managing their debtors overly effectively, and they'd let them blow out quite a bit. So a reduction of 11 days in their debtor days, their receivables, they felt was absolutely achievable. Incidentally, this particular business has more that it can improve in this area. However, they thought for a first draft, 11 days is more than achievable. That there over the 12-month period is going to add another $120,000 cash to the business. Inventory reduction, yep, they believe that they were carrying surplus stock. They do get regular access from their suppliers. They're delivering regularly. So a 10-day reduction in stock holdings was more than achievable. It's an $84,000 benefit there to cash. And then they can increase their supplier payments by 2 days. So they were paying relatively quick. They want to keep their payments well within terms. However, they think that they can very easily just get a 2-day win there. So collectively, when we look at that, and you can see it on the screen, that becomes quite a significant impact. And if we look at the opportunity there, that's a $250,000, $246,000. Thanks, Russell. That's a $250,000 improvement there in cash flow. In this case, and this is important. In this case, not one additional dollar in sales is required to increase the cash available in the business. And I think that's an important one to note, is that we can see that all of this is tied up in working capital and getting some wins over the operating expenses. But yeah, not one additional dollar has been tied up in making more sales. It's sitting there in working capital. So in looking at this, it's about understanding what's achievable across those 7 levers. Obviously, this client, it wasn't achievable. They didn't believe to increase prices further, increase volumes, etc. But they felt that conservatively, and that's important to note too, there's a $250,000 win, but conservatively they feel that they can make those achievements across those 4 elements of the business. Is this helping? Is this making you, is this provoking thought around your own businesses? Again, thumbs up if this has been helpful. Great, thank you. I'll keep it moving because I know that we're getting probably running out of a bit of time here. I just now want to get into the timing aspect. And look, I know that we all know that cash flow comes down to timing, but I think when we put it in front of us, and you can start again, I hope it just provokes some thoughts in your minds and triggers in your own minds about your own businesses, that it might sort of flush out a few more things there as well. So what we're really going to look at here is, if I just click through in this diagram, what we can see is that on day one is a business that might be carrying some inventory will buy the stock. And I do acknowledge it's an extreme case, but it's done so to just demonstrate the point. On day 4, that supplier invoice will come and you pay for that stock, or this business might pay for that stock. On day 118, that stock gets sold. On day 245, payment from the customer arrives in your bank account. So we're looking there, 245 days between ordering the stock and then actually getting paid for the stock is actually passing by. So you've got from day 44 to day 255 that the business is funding that inventory. So we look at it a little bit further. So day 44, when you pay for the stock to actually selling the stock, there's 74 days in there. And then there's another 27 days between selling it before the client actually pays for the stock. So that's 201 days between you paying, or this business paying, and actually getting paid for it. Now, in a services business, this may look a little more like, on day 1, the services performed or work starts. Day 44 maybe that staff are paid. On day 118, there might be a progress invoice that's raised. And on day 245, you actually get paid from the client. So the point, though, whilst it is an extreme case, is that, cash flow is about when cash flows through the business. And again, I know this is relatively a simplistic diagram, but if you can just map for yourselves as to where you feel you're performing in those areas, and it really does show out where there might be an opportunity to either A, invoice faster, or B, collect faster, C, maybe get some better terms where you can pay maybe a bit slower to your suppliers. So again, consider your own business in looking at this, and the question is really, how long is it between paying for something before you're actually receiving some money from the customer? So at this stage, and look, I'll keep it flying, but at this stage, what my hope is that there's 2 things that have jumped out to you. One is, where are there opportunities available in your business, particularly across those 7 levers, and starting to frame up the timing of cash moving in and out of your business, just so you can get a little bit more control over where you may need to dive a bit further within your business. I'll move through these last few slides pretty quick. What we're hoping to do here is, now we'll definitely share these slides with you afterwards, but for those of you that want to go and just start maybe exploring some of these opportunities a little faster, is that, look at just a quick self-assessment of your business. So go through each of those 7 levers and just rate them. Just use your gut feel. Don't overthink it. Does it need attention? Could it improve? Or is it performing quite well? And from the price point of view, for example, I won't go through each of these, but it could be something as simple as, are we reviewing our prices regularly? On volume, is there an opportunity to grow the market, increase market share, or introduce new products or services? So just go through each of those and just rate yourself as to how you're performing there. And again, I'd encourage you, don't overthink it. Just use your first instinct and identify where you think the business may have an opportunity to improve. Where to start? Again, just get some visibility across those 7 levers. So get a feel for, if you don't actually report or see, how your debtor days are performing, how many days it actually is till you get paid, start to pull out some of that data. What are your debtor days? What are your creditor days? How long are you holding inventory for? Or what are your WIP days? The average days that service or that work sits unbilled for the client. Determine what's achievable for your opportunity. This is a key one. We realise that we can't all go out and lift prices. We realise that there's not always opportunities to receive faster payment from clients, but what is achievable? Look at them with an objective eye and see what is achievable, and then workshop those improvements. And I've got just a bit of an outline here, which you'll get in the slides as well. Again, for those of you that are interested, keep the workshop pretty simple, but and don't necessarily come away with 20 odd initiatives, but look to identify what are the opportunities that matter the most. And if you're a business that's got a larger team and it's got maybe some functional management in that business, involve the team. Pull them out, get their impact. Look at where you're performing well, where you could improve. What are the ideas that you have, and just jot them down on a post-it note. Then pick the top 3. Once you've got the top 3, then just evaluate those and just make sure that someone's accountable. Someone needs to be accountable for the outcome and own that outcome to see that it moves through the business. And this last one here that I'll pull up is, I'd suggest that improving cash flow is an iterative process. So it's not a one-time fix. It'll be something that you'll iterate over time. And if it's not part of your management reporting, I'd certainly make it a part of that, and I'd make it a key discipline to take the mindset of monitor and repeat. As we've looked at some impacts there in those slides earlier, is that we'll work with clients that may look at, they can see that there's an operating expense opportunity that they can pull some expenses out, but the first draft might be they'll pull the 2% out. Then they might look at that next 2%. Or in the case of the example we looked at, they could reduce debtor days by 11 days, had a $130,000 cash benefit. There was still another 10 days in this business, but they thought, let's not go the whole 21, let's just go 11 days first, and then we'll come back, revisit it, and then we'll go and execute on the other 11 days. So monitor, repeat, and repeat. Again, if you're a business that has some sort of supervisory roles within your business, I think it's worthwhile too to get an idea around what good performance, average performance, and bad performance looks like. So one is it will guide the business, but what it does is it guides how the business responds. So, for example, if we look at gross margin, the ideal 40% gross margin. So if it's performing above 40%, that's great. The team knows that, okay, we're on track. We just need to maintain the momentum. We can see that if gross margin slips to 37% to 48%, and again, these are just examples for you, but the team understands that, okay, the result, it's not far off, it's moving in the right direction, but discipline is needed. If we look at then when it's below 37%, again, the business and the team recognises that, okay, performance isn't where it needs to be, and perhaps questions need to be asked around, whether the strategy or actions might need to change. And the benefit around this is it starts to shift the business towards some more structural outcomes in terms of managing cash flow and performance as opposed to ad hoc. Now, I'm going to wrap it up now before there's any final questions. But before I just do that, is that now we'll make available to you the option to just continue this conversation. We're very mindful that the cash performance of each business and each industry sector is different. The opportunities that are going to be available in each of your business are going to vary widely from one to the other. And obviously, we haven't been able to jump into looking at your own unique situations or discuss them in today's environment. So that's why after this, we'll reach out to you. We'll make contact when we send you the notes and the recording. But we'll make available to you a 30-minute online session, just a casual catch-up. We can have a conversation about your business. And look at where the biggest opportunities may be, and importantly, whether implementing those opportunities will likely have a positive or a negative effect on other areas of your business. So if you're curious to have that conversation, we're obviously more than happy to explore that with you. I'm hitting 45 minutes now, so is there any final questions for the chat? If not, I'll close the meeting. Please, again, if you can give me a thumbs up or something if that was worthwhile, or come back in an email after the event to let us know if you've got any other feedback. We're going to do more of these. We want to try and keep them quick, short, and sharp, and very practical. So, feedback on topics or even how you'd like to see the format of the meetings would be approved. Appreciate you all dialing in. I will close out the session now. And thanks again for your time, and we'll get the presentation and recording out to you. Thanks all. Have a great day. Bye.